Good morning, ladies and gentlemen. Welcome to our Colliers Market Outlook 2023 briefing. In this session, we'll share an expert update of what we can expect within the year ahead. The main theme is cautious optimism across many of the city's property sectors, and we look to share the main insights and recommendations with all of you. I hope that all of you will enjoy it. Now, I would like to pass on to our Head of Research, Ms. Kathy Lee. She will share with you our presentation of the market outlook.
Thank you, CK. Good morning, everyone. After years of COVID fighting, 2022 was an even more challenging year, combined a number of external headwinds, including rising global and local interest rates, weakened trade, and the decoupling of US and Chinese economies. The city experienced very limited number of visitors, and it also has encountered the loss of residential population and talent, both local and expat, which has impacted the workforce as well as the general business operations, and this effect in turn flow into the rental and capital value of our residential properties. Hong Kong's economies contracted for 3 consecutive quarters in 2022. And after years of the business disruptions and stringent anti-COVID measures, Hong Kong now can finally develop a sustainable roadmap for recovery. The Hong Kong government has announced and put forward a number of supportive measures to attract international tenants and foreign investments, including the Top Tenants Pass scheme and the Office for Attracting Strategic Enterprises. This should help to strengthen Hong Kong's regional post-COVID competitiveness and facilitate more sustainable economic developments in the local economy. A slowdown in US inflation may ease the pressure for further interest rate spikes in 2023, which should help stabilize global investment sentiment. And a rebound in China's economy will help to drive growth in Hong Kong's economy. However, there are still some external headwinds, such as the continued geopolitical tensions and a potential global recessions, which may undercut Hong Kong's economic recovery. Now looking at the office sectors, the Grade A office markets have shown signs of recovery in the second half of last year, with positive full-year net take-up of 350,000 square feet, which is the first of such since COVID. However, the gradually recovering demand was overwhelmed by an abundance of supply. Close to 4 million square feet of new Grade A office space rushed into the market and shooting the overall vacancy rate to 14.7%, which is the highest since 2003. Therefore, overall Grade A office rents continued to decline by 4.5% in last year. Cost optimization for corporates was the key demand drivers for decentralization in 2022. On the other hand, the flight to quality has supported rents as well as the occupancy levels in core districts, including Central. The ample of new supply seen last year, especially in non-core districts, has intensified the competitions and pushing up vacancy in some of the submarkets, result with slightly higher rental declines in those districts. We expect the border will open, will boost business travel. Leasing demands as well as activities are also expected to increase, particularly from mainland companies, which should strengthen office rents in CBD and the Colliers Station area. We've also noticed an increasing activity from the insurance and banking sectors, especially easing on the TST submarket. However, the supply boom of 3.2 million square feet of Grade A office space this year and the high vacancy will continue to weigh on any major rental growth rebound in the market. Therefore, we project the overall Grade A office rents will increase by 3% in 2023, led by the Central, Admiralty, and Tsim Sha Tsui submarkets, which will see a 5% and 4% of rental growth respectively. at the retail sector, the retail market has stabilized and gradually recovered from the fifth wave of COVID in second half of 2022. And we have seen the bottom out of rental decline and an improvement in overall occupancy levels. However, the progress was offset by the implementation of 0+3 policy in September, which drove local residents traveling out. So retail sales value in the city registered a contraction of 1.1% in the first 11 months of the year. Overall, high street rents remained flat in 2022, while the CBD submarkets registered a recovery of 1.7% with a notable improvement in the take-up and the vacancy levels in that submarket. Up to date, the high street rents still about 31% lower than the pre-COVID level. In terms of outlook, the border reopen will definitely boost market sentiment, fueling leasing inquiry and activities, and supporting rental growth in core, traditional tourist locations. Average rents on high streets have already back to the SARS levels, and we expect it will need the post-COVID recovery when the border reopen. We expect high street rents will continue to grow by 8% in 2023. The recovery will be more notable in the second half of the year, whilst we monitor the number of inbound tourists and their travel and spending patterns in the coming months. We believe the premium lifestyle and accessories, health-related trades, as well as family entertainment sector, which were the main demand drivers in the past couple of years, will continue to expand. Subject to the positive resumptions of border traffic, luxury goods and cosmetics will also pick up gradually. The shopping center segment is welcoming approximately 3.9 million square feet of new supply in 2023. This including 2 key projects in Kai Tak, 2 projects by MTR, and also the phase 1 of 11 Skies in the airport location. This supply volume is actually the highest in the past 20 years. This will provide more diversified shopping experience to shoppers and yet competitions in the leasing market. Developers may need to be relatively flexible to attract tenants. Local consumptions will remain as an important driver for Hong Kong's retail markets in the short to medium run, so as the neighborhood retail. We have identified some districts with past population growth and relatively lower level of mall supply. That means a lower retail area per capita ratios. These areas, including Lofton District, Tai Po, Yuen Long, this area will provide more business opportunities for retailers and landlords. And these districts are also the new development areas in the north and northwest of New Territories. Now looking at the industrial sectors. Hong Kong's industrial property markets have been supported by demand from multiple sectors, including e-commerce, food-related industry, and also self-storage, which support the rental growth in both the warehouse and general industrial segments. Online retail sales in Hong Kong continued to grow in 2022, up by 22% in the first 11 months of the year. The booming of e-commerce sectors triggers demand for the 3PLs. Overall, warehouse vacancy remained at a very low levels of 3.3% at year-end 2022, and supporting a rental growth of nearly 7% last year. On the other side, rents of general industrial properties also grew by 3.7% in 2022. Looking ahead, industrial rental values are expected to remain resilient in 2023. The reopening of border will facilitate Hong Kong's economic growth and maintain leasing demand for industrial properties. We have looked at the 3PL operators are still closely monitoring the markets for opportunity to expand or consolidate their leasing portfolios. We expect there is a temporary shortage of industrial supplies in the northern districts in the coming 3 years due to the resumptions of the brownfield sites by government. In terms of warehouse supply, there are new supplies of 3.8 million square feet of our premium logistics centers, which is one of the largest logistics centers in Hong Kong. It's scheduled for completions in the second half of this year. We believe due to the specific locations and positioning of this new supply to attract air flight dependent occupiers. So we believe this new supply will not strongly impact on the warehouse rents in traditional logistic hubs such as Kwai Chung, Tsing Yi, and Tsuen Wan. We forecast both general industrial and warehouse rents will continue to rise by 2% in 2023. Hong Kong's investment markets remained subdued in 2022 as a result of sharp interest rate hikes and suppressed commercial property rents. Number of the transactions last year was almost half of such in 2021, with only 101 big deals being concluded, the lowest levels in the past 10 years. However, the total turnover was stood at $70 billion, only down by 4% compared to a year ago due to a number of big ticket sales record. Distressed sales was the hotspot in the market, and funds were the key players amongst for over 60% of the total transaction value. We believe investors will continue to seek defensive assets with reliable rental incomes and also flexible leasing terms to prepare for future rental increase in 2023. We expect funds, on the other side, will adopt a more wait-and-see approach and slower their purchasing activities. In turn, leaving the cash-rich local investors and family offices who are looking for attractive assets to become the major purchasing power in the first half of this year. We believe distressed sales will remain popular in Q1 as they offer bottom fishing opportunity for investors. Investment volumes in 2023 is forecast to increase by about 5%. But the market will remain slow in early this year before steadily pick up in the second half, subject to the specifics of the border reopening. We expect rental premises will continue to be the treasure hunting paradise for local investors, and high street shops' capital value will increase by 8% in the year. While border reopen, we will also benefiting the hotel segments in hope of the higher RevPAR. Demands from mainland students will also increase, adding the opportunities for landlords converting hotels into student accommodations. In fact, both occupancy and RevPAR have picked up in November last year following the end of hotel quarantine in September. With limited supply in the hotel segment, alongside the return of visitors, will support growth in both room rates and RevPAR, which will drive investment interest in this market. And the recent transactions of Panda Hotel in Sempogong by a joint venture of Anglo Gordon and Run On in late December, suggesting a return of investment interest from institutional investors in the hotel market. In summary, the Hong Kong property markets have been supported by a number of positive factors, but there are also some negative factors we have to be looked out. We have forecast most of the property assets in Hong Kong will increase in both the rental and capital values. But because of the high interest rate environment, we forecast the mass residential price will continue to decline by 5 to 10% this year. And this is the end of my presentation, and I'm now handing back to CK. Thank you.
Thank you, Kathy. I would like to start our panel discussion right now. And I would like to start with the investment market first. Thomas.
Yes.
Many investors are concerned about the interest rate rise.
Yeah.
Do you think the U.S. interest rate have already peaked? And how would that affect the real estate investment then?
Well, the market predicts that the interest rate hike will slow down significantly in comparison to last year. and hopefully reach its peak during the first half. However, even though it may reach its peak during the first half, the interest rate level will actually hover at a relatively high level compared to these few years. Meaning, the cost of capital will also rise. Hence, the required return and the required cap rate will also rise. Okay. So, this may put pressure on the investment demand and on the pricing. However, having said that, since the interest rate hike from last year, we've seen actually a lot more distressed sales in the market. And this is stimulating the transactions. Also, one thing to note is that some of the developers are willing to give discounts on the non-core assets and recycle the capital to buy in some other projects at a down cycle. So we hope to see that in the first half of this year. This trend will continue.
Thank you, Thomas. Kathy had mentioned about the reopening of the border and the influx of tourists into Hong Kong. Cynthia, I would like to know, how will the landlords of high street shops, major shopping malls respond to this increase in tourism? And how would they position their malls or their shops to attract tourist footfall then? Yeah.
Thank you, CK. Well, upon border reopening, because of the increase in inbound tourists, every single landlord in Hong Kong is actually very excited. Particularly two types of landlords. Grade A shopping mall developers are very excited, especially with the heavy luxury tenant mix, and also the core high street, first tier high street landlords who are having a wait and see model, very hopeful that the bigger brands and the stronger groups may come back and take up the new leases. And how they're responding to this is that they will try to look at each other to see whether any new exciting brands are actually coming back, and also whether the spending pattern has increased and whether the market can go back to the previous days pre-COVID.
Okay, thank you. Cynthia. I would like to turn on to Fiona, because the office market is a very important component of the Hong Kong economy. I would like to know, from your perspective, where will office leasing demand coming from? This year in particular, and would you expect? Because we have been talking a lot about the Chinese economy, whether there will be a lot of activities coming from those PLC enterprise, and if so, what sort of locations will these interests be focused upon? Yeah.
Thank you, CK. Recall last few years, the main key drivers of the occupiers were cost saving and cost saving. So I think this cost saving key driver will keep continuous in this year, 2023. But however, when we look at about the market transactions, we can make some very short summary on this. Most of the transactions mainly will be from the occupiers. They would like to upgrade their building qualities, or maybe because of the building is going to demolish. That's why they need to relocate. I think that this is the two main demand from the market, and that will be keep continuous in this year. Of course, I think the reopening of the China border is a good news to Hong Kong economy, definitely. And I think recall the December last year, actually most of the inquiry come from, not from PLC, but mainly from the MMC and the local enterprise, and mainly because they have the opportunity to look at the business rebound again. But of course, I think it's too early to give any comment about whether the PLC business will be returning very quickly. I think the impact, we'll have to look at and observe about 3 months to 6 months time, then we can make a very clear conclusion about this.
But Fiona, would you expect, these of PLC, enterprise, if they do come into Hong Kong, what sort of, location or building quality that they will be looking at in particular?
I think some trophy building, for example, like in Central, will be definitely their first choice, core location. And secondly, I think somewhere near to the XRL terminus will be also their second choice. So that means the inquiry likely to go to the core Central, and also where that will be on Cantor Road plus the Western District Cultural area.
Thank you, Fiona. I would like to turn to Bill these days. We know that Hong Kong has always been facing limited supply, even including industrial warehouse type of stock. From your perspective, can you talk about what would be the sort of upcoming supply in the market, and how the new supply will shape activities and trend for this year then?
Okay, thank you, CK. Well, as we know, Hong Kong basically is always facing the limited supply of industrial site. What we know from the government that there will be a brand new logistics center available in Q3 this year. That is a world-class, ramp-up access warehouse developed by China. Basically, for that warehouse, it can basically provide close to 3.7 million square meter. But of that space available, it will only provide close to 1.7 million square meter available for lease on the market. And from our observation, it will only, well, I would say in the short term, it will only create some sort of burden for buildings nearby because, there's some ramp access warehouse near the airport for many years, and this is probably, the limited supply, available recently. It will create some sort of burden, especially for the rent, for those buildings nearby. But basically, it will not create some impact for the, for those warehouse in the traditional logistic location.
Okay, good. I would like to back to, Fiona. We see, a number of new, office supply due to the government action, in recent years, to create more new, office space. And that, we have also seen many, grade A projects being launched into the market. Of course, people are looking for good quality stuff these days. For existing landlords and landlords of, new projects, how can they remain competitive in the market or attract, tenants, to pay good rents for them then?
I think regardless of the good rent, because the market already downturned for 3 years, and now back to the, I will say, normal level. And for the new developments, I think the landlord have to pay attention to something like ESG, because it's something that the the multinational company, they really have to look at and look after it. For the ESG issue, the reason behind it, because most of the MMC actually they have a compliance to fulfill, especially in the year of 2000, either 25, 27 or 2030s, that the building itself can comply to the company compliance like ESG elements. So that's why I think in order to be more competitive and to win over the competitors, the landlord side, so I think ESG is the key issues.
But Fiona, would the ESG be something, of a sort of medium to long-term nature, not really, short-term? Anything, short-term that you can make recommendation to our clients?
I think at least the BEAM Plus is the basic requirement. Of course, I think in the long term, they may need to fulfill the LEED Platinum requirement. So even without the BEAM or the LEED, actually some of the MMC company, they can't actually to lease that spaces. We have come across one of the situation in the last year. One of the MMC, they would like to consolidate their space and relocate. But however, once they shortlist the building, 5 buildings are on the list, and one of the building actually they can't even fulfill the basic one, which is the BEAM Plus. That's why that building is quickly eliminated from the list. So that's why I think this is very necessary for the landlord to fulfill at least BEAM Plus, and in the long run will be the LEED Platinum.
And I would like to follow up further on this. For new projects, it would be quite easy, for developers, new landlord to incorporate these sort of features.
Yeah.
Would you say that, for the existing buildings, many of our clients, they own a large large portfolio.
Yeah.
Would you recommend them to really think through, how they can increase or improve the quality of their buildings?
Yes, indeed, I think for those landlords, in fact, they don't have this kind of the ESG certificate. I would advise them to maybe meet our ESG expert to see how can they fulfill that path and in order to make this completed. So in fact, some of the building, in terms of the building age, even if they are too old in the age, or maybe in terms of the infrastructure-wise or the hardware, they can't fulfill this sort of the basic criteria. In fact, we have the expert helping them to go through the path in order to achieve the minimum level. So of course, I think this is good to have the landlord to understand about this is a very minimum criteria in the long run. But in the short term, some of the tenants, if they can still renew and stay, And I think for the short-term ones, maybe they don't need to fulfill that requirement immediately. But however, in the middle terms and the long run, they still have to make it. So that's why I think returning to your questions, usually I think if we meet the landlord for the market presentation or the regular update, we always advise the landlord. This is a very key and important element you have to consider, I would say, and that's why some of the old portfolio, for example, in Tsim Sha Tsui, Wan Chai, and Causeway Bay, and that would be a target to meet the landlord and advise something like this.
Okay, thank you for your honor. I mean, that's very important. That means, I mean, we need to see, I mean, properties to be continuously upgraded in order to meet with the expectation of tenants, I mean, in the market. And I would like to turn to, I mean, Cynthia again. Because, I mean, when I look at what the Hong Kong government have been doing lately, they have been stressing that, I mean, Hong Kong needs to be innovative and that we need to adopt more technology. And that for the retail sector, I can see that for the last few years, I mean, Hong Kong have been suffering from COVID, and that, I mean, many consumers, they have changed their shopping pattern. They switched to online, even including, of course, I mean, ordering food. The sales, I mean, in the retail sector have gone up, I mean, a lot on the online side. Is this a trend that you still, I mean, consider will be continuing after, I would say, we are now back to normal post-COVID? And how will this affect, I mean, the retail, I mean, leasing sector then?
Thanks, CK. Inevitably, online sales are definitely increasing with its popularity. However, Hong Kong remains as a very small and cozy city with a very attractive shopping image. Therefore, everyone who lives in Hong Kong actually go out to shop very often. And having said that, a lot of brands are actually having physical stores to provide consumers with different shopping experience, which is very important to the consumers. Sometimes consumers need to associate with the brands for that feel and touch of their products, and also as an outing to explore. This is all part of the marketing of the brand, which adds value to the online sales. So physical stores are also very important. Those two, like physical stores and online, are actually complementing each other.
It's good. Thank you, I mean, Cynthia, for that. I mean, Bill, I mean, back to you. Because, I mean, the industrial space is very important, I mean, for the economy in Hong Kong. Mm-hmm. I mean, Kathy have forecasted that the industrial rents will grow by around 2%, I mean, this year. Mm-hmm. Can you talk us through what drive, I mean, this growth? I mean?
Thank you, CK. Well, let me explain, you know, the rental growth, that we forecast, 2% rental growth this year. Basically, I would say over the past 10 years in Hong Kong, for the industrial property, basically, you know, the average rental growth probably in the region of 2 to 3%. I can tell you, you know, honestly, that 2%, you know, rental growth is, from a point of view, is a pretty conservative prediction. We do believe that, you know, due to the reopening of the border, that the business situation will be improved a lot. And what we know from those e-commerce retailer that they do expect, you know, there will be a huge, you know, a remarkable improvement in business, and so from a point of view, you know, I think the major factor is the reopening of the border, and obviously the limited supply of the industrial space will also help, you know, to improve, you know, the rental growth. Yeah.
Yeah, I have always, I mean, been reminded by many clients that, I mean, as the government, I mean, continue with this resumption, I mean, activities in the new territories. Lots of those sort of, I mean, brownfield sites, I mean, like in places like Hong Shui Kiu.
Yes.
We have some 200 hectares of space, I mean, will be resumed in due course. And that, I mean, have caused a lot of, I mean, changes in the market already.
Yes,
yeah.
yes.
Yeah. Okay. Yeah. Thomas, yes. We have put a lot of emphasis, I mean, Kathy, I mean, Cynthia, and also, I mean, Bill, onto the, I mean, borders reopening. How does the reopening schedule, I mean, will affect the investment market? Do you think there will be an immediate influx, I mean, of capital to Hong Kong, I mean, property market from China these days?
Thank you, CK. Yes, you know, the long-awaited reopening of the border Of course, the returning of tourists, business travelers is going to help the economy in general, and also, give more confidence for the investors to start investing. In fact, over the past couple of weeks, we already seen investment activities pick up, especially in the retail sector, in the hotel sector, and so forth. However, will there be an immediate rush of Chinese money into the market? Maybe not, but it will gradually pick up, and the speed may pick up more in the second half of the year.
So this is the expectation. The second half will be better in terms of activities.
Yes. However, the first half, we will still see some activities, but mostly dominated by local cash-rich buyers.
Yeah. Okay. I think I'm looking at the questions. We have one question here relating to the retail sector. Back to you, Cynthia. The question starts with like this. Have you noticed any new brands, in the new trends in the retail sector? Do you notice any changes in leasing, inquiries right after the border reopening news have been announced? What is the initial reactions, to the news then from the market? Yeah.
As from last year, from Q4 2022, there has been quite a strong demand coming from various international brands from overseas. We start to looking at Hong Kong again, and the bigger brands that are looking to renew and expand in Hong Kong. However, they will do this very cautiously because they have only just come out of a very gloomy period. Therefore, everyone is taking a very cautious optimism view. Having said that, I cannot see immediately in the first half of 2023 that brands will be reacting very quickly. They will definitely adopt the wait-and-see model. And then for second half, if the sentiment continues to improve, that people will definitely take up first-tier high street leases.
Yeah, thank you, Cynthia. I would like to echo, some sort of, feedback that I've got from major, more landlords. Actually, because I've not been speaking like, Cynthia, to the high street shop, owners that frequently. But from what have been seen so far in the market, major landlords have seen, the tenant inquiry have increased.
Yes, definitely.
And that, tenants seems are quite prepared to raise the rents. Partly, to compete for the space, and partly, in response to possibly, some landlords' requirement. The rents have already bottomed out, and that rents, should continue to increase by now. Yeah. Perhaps, I would like to get back to, Bill again. When we look at, Hong Kong, we normally talk about industrial sector in the sense that it will be warehouse, industrial space. What do you see, just for deals of other types of investment like data center, cold storage? Because we have heard, that many investors are looking at this sort of, asset class these days.
Thank you, CK. Well, for data center, I would say there will be main constraint here in Hong Kong. That is the power capacity. In those famous area, such as the Kwai Chung, Tuen Mun area, you will find that is the the second popular place for data center compared to the Tseung Kwan O. But obviously, right now you will see that the area is restricted by the the power supply. As what we know, you probably have to wait for at least 7 years to get your to get the sufficient power supply for a normal data center there. So we realized that there are some inquiry recently looking for different places like Tuen Mun or Yuen Long to see whether there will be suitable places for setting up the new data center. But also you also mentioned the recently there are lots of inquiries for the cold storage space, right? And we found out that for those institutional funds, they like to work in closely with those operator, like a cold storage operator, to look for either those en bloc industrial building or those stratified industrial building for setting up, the cold storage space. What we know that, over the past 3 years during the pandemic periods, the e-commerce business improved a lot, and especially for those F&B related business. People like to order in food online. So we noticed that there's a huge demand for the cold storage business. It explains why those institutional funds find out that that is the golden opportunity to invest the money in that special field by partnering with those cold storage operator. And up till now, I can tell you honestly that the demand is still there. Those investors, they are still looking for suitable industrial space for setting up the cold storage here in Hong Kong. Yeah.
Yeah. I would then like to follow up, with what, Thomas has said about the investors' sentiment these days. Because recently we have seen, the government, in terms of the land sale, they are prepared to sell the Kai Tak land at 6,000 something, AV per square foot. But then, for the Stanley, Zhong Ham Kok, low density residential land, they withdrew it from the market. Mm-hmm. When you talk to, investors or developers in Hong Kong these days, would they have this sort of, concern about, the population have decreased, whether the government plan for attracting enterprises, population or talents to come into Hong Kong, whether that would so-called fill up the hole that we have experienced in the last 2 years, whether they are still confident in the future of Hong Kong, as a whole?
Thank you, CK. In general, when I talk to investors, both local investors, high net worths, developers, or even institutional funds, which we've seen a lot of coming into the market last year, right? If we look back at the transaction chart, 62% of last year's transaction were foreign money. Okay, so getting back to your question is, yes, they see Hong Kong still as a very important gateway city to China. All right, so that's one thing. But getting back to the land sales or the discounted sales, or the land sale that withdrew from the market, I think partly is because the interest rate right now is at a very, very high level. All right, so for investors to go into a project that is not currently producing income will put a lot of burden on their cash flow. All right, so they will proceed very cautiously. All right, so what we have seen, especially from the funds or the high net worths, is either the asset has a lot of discounts. For example, there was some receivership sale in the market recently, right? This discounting 30 to 40%, and is picked up by institutional funds, okay? Or the asset itself is producing a relatively good income, so to cover the interest expense and the potential upsides.
Okay, thank you, Thomas. Perhaps I would like to switch to, Fiona first. Because we have 2 questions coming in. I would like to start with a question on the office side first, and leave, Thomas to rest for a while. There's a question relating to, does the new public portfolio in West Kowloon show a potential decline, in Central's appeal? That means it would be a challenge, to the Central's position. Will Central still be a core location for the finance, legal, and other professional services sectors?
I think Central is still definitely Central, and they have their own identity, and people already consider Central is a location for the business like bank finance and professional business. So that's why I don't think anything can replace Central. But of course, I think the Western District Culture will be another exit for the occupiers to spin off their operation or relocate for the cheaper location. So that's why in terms of the area, I think Western District Culture nowadays still only about 2.2 million. But in the future, it's going to be 6 million. But it's still smaller compared to Central. That's why I don't think they can replace Central at this stage.
Okay, Central is still a very permanent location anyway. Okay, I would like to back to, Thomas. It's on I would say a wider perspective. Rather than just focusing upon Hong Kong. Capital flow around. Across the globe. And that this question relates to the Colliers house view. Perhaps, Kathy may add to that. If appropriate. Given the interest rate environment, the Hong Kong interest rate follow. The U.S. interest rate, and due to the PAC. And there are, other markets, which may not be so-called directly, driven by the U.S. interest rate as such. Will the institutional capital, come back to Hong Kong given the interest rate height, and whether the growth story of Hong Kong, and I would say, also including China here, and the more attractive investment, returns in other APAC markets. So it's a relative, comparison between Hong Kong and other parts of APAC. People, places like Japan. We have heard a lot of stories over there, and capital have been attracted to Singapore and also Australia. What are your feelings when you're talking to those of major institutional funds these days? Then?
Yeah, thank you. Thank you for the question. When we talk to investment funds, institutional buyers, yes, as you put it right, CK, the capital flows around. So during the past 2-3 years, when we are in lockdown, semi-lockdown, closing off the borders, interest rate hike, which we are kind of forced to follow the U.S. Capital did slow down. Investment activities did slow down overall, right? So in comparison to 2021 to 2022, the investment volume have dropped, all right, to $70 billion, where it was, I think it was $73 billion the year before. And as Kathy mentioned, and in our report, the number of transactions dropped by almost half. But one thing to note is that even though the number of transactions dropped, the total volume only dropped by about 4%, all right, and 62% of those came from overseas capital. I think during the past 2 years, yes, some of the investment activities actually went to Japan, went to Korea, went to Singapore. But again, it's a cycle. So the property prices there has risen to a certain level that maybe for some institutional investors, some funds, may be harder to underwrite now. And with the story of Hong Kong from this year, the reopening of borders, when the interest rate hike is closer to the peak, some of the investors are actually coming back to find opportunities here because they feel that the story, the upside, it's in Hong Kong right now.
Okay, thank you,
Yes.
Thank you, Thomas. We have got a follow-up question, for Fiona. Because when we are talking about, central office market, and then, the upcoming, supply from, the West Kowloon, including the likely the West Kowloon Cultural District, apart from the XRL, site. The Causeway Bay, Wan Chai area is still a big area, which we have a lot of existing buildings.
Yeah.
How do you see this sort of differential between, these sort of locations, given the new supply?
I think for the floor plate size-wise, in fact, most of the office building in Wan Chai and Causeway Bay is comparatively smaller. And except some several buildings in the North Wan Chai, I would say. And that's why usually for the tenants, if they need to select the building for relocation. So Wan Chai and Causeway Bay may be good for the luxury brands and also for some of the local trading company and shipping company. But however, for MMC, if they have to look for the permanent location, other than a central and western district culture, usually I think Wan Chai and Causeway Bay may not be the destination in terms of the floor plates and also in terms of the building age and in terms of the building specification. So that's why I think for those landlords actually in Wan Chai and Causeway Bay, I think they may need to, if they redevelop the location or redevelop the building, they may need to build a bigger floor plates plus high ceiling, more natural lighting. And otherwise, I think that would be always be the location for some of the PRC company or maybe the urban location, office location. Yeah.
We still have a question coming in, possibly. I mean, we are approaching the close of the session, but this sector is on the industrial sector. A question which is, I would say, quite interesting, I would say, because the question relates to, is strata title, industrial force more popular among investors these days? If yes, why?
Well, thank you, CK. Thank you for this question. You mean, is the strata title access more popular?
The question is asking
nowadays,
in that sort of direction.
I would say that it really depends on the price. It's nothing to do whether it is en bloc or strata title. But I think for lots of transactions here in Hong Kong every year for industrial access, I think most of those strata title transactions is by in the region of 3 million Hong Kong dollar or 5 million Hong Kong dollar. I mean, those are popular for those small investor or end user. But nowadays you will see that in terms of the price transaction, well, I would say last year, you will find that the price is more or less, well, it is not suffer any change. I will give the recommendation for those investors if they look for property for stratified industrial building. Firstly, just like retail sectors, location. For those stratified building, try to find those premises within close proximity to MTR station. That would be easy to rent it out. Okay, yeah, location. Secondly, of course, if the price is well below market price by 10% or 15%, go straight, and then start negotiating with the seller.
Bill, we will not let you go easily, because the client would like to clarify is the strata title, sort of properties, will be focusing upon from the perspective of institutional clients, in particular funds. Whether that will be from an investment perspective rather than location.
Okay. For the stratified building, if I would say nowadays, institutional fund will look for those stratified building if it is suitable for conversion either as cold storage space, or that stratified building has any potential for redevelopment. Say you will find that some institutional fund would like to acquire those buildings with ownership close to 80%, and then that property is likely for redevelopment. Then for that stratified building, those institutional fund or those major investors will try to look for opportunities from that stratified building. Yeah.
Okay. Yeah. I would like to invite more questions from the floor if possible. But while at the same time, I would like to so-called supplement relating to this question, because normally when we talk to clients, they would like to look for an en bloc. That means they can control the whole plot of land, the whole property, not to be so-called subjected to the mutual covenant, etc. Normally, the investor would prefer whole block to strata title premises. But as Bill had mentioned, it really depends on the price. If it is really attractive, the yield is good, then the strata title would be also would be attractive as such. Okay, we have another questions coming in. Again, back to you, Bill. Where do you see the opportunity in the cold storage sector, given that majority of the older industrial space would not have the right specification for this type of product, that means cold storage? Is strata a solution to this versus building en bloc supply? So again, focusing that there must be some investment consideration here, following up on this specific question. Yeah.
Thank you for the question. I have to admit that will be quite difficult to look for stratified industrial building for the use as cold storage, because of this stringent requirement for setting up this cold storage nowadays. Well, we with quite a number of inquiries for this special investment, and there are some solutions to tackle this requirement. Yes, some investor would like to look for industrial site and try to build have some sort of build-to-suit premises as cold storage. There's a very famous institutional fund or real estate fund recently acquiring an industrial in Kwai Chung, and I hope that building will be mostly will be used as cold storage 4 years later. And we also have some interest party to look for those stratified building, but that would be quite difficult. But it's possible, in different areas, setting up cold storage premises. But obviously, finding stratified building, I have to admit that it's pretty difficult, nowadays.
Thank you. Thank you. Bill, but it seems that our clients would not like to let you go so easily.
Okay. I'm willing to answer in that.
Yeah. Are the investors, still looking into conversion or redevelopment of old industrial buildings into modern industrial, data center, cold storage, office uses, under the revitalization, scheme of the government? So perhaps this question will be focusing upon you, and also possibly, Thomas may add, some comments on this.
Okay, thank you for the question. For the revitalization scheme, 1.0 and 2.0, I would say over the past 10 years, we will quite a lot of inquiries by exploring whether it is suitable for converting into office use or cold storage or even data center. Over the past 5 years, when there were quite sufficient power supply, it is possible, to acquire those industrial building and convert it into data center. But nowadays, as what I mentioned, limited power supply in lots of areas. On the contrary, we receive quite lots of inquiry for converting either some stratified industrial building by fitting this specification into cold storage. And also, there are also some inquiry for acquiring the industrial site and converting into cold storage. But it takes much longer time, at least 4 to 5 years. And I can say that the requirement is still there. That's why we are also helping those interest party to look for either stratified industrial building or en bloc industrial buildings nowadays. Yeah.
Thomas, anything to add from your perspective?
Yeah, thank you, Bill. For industrial land or industrial building for conversion to cold storage or data center, I'm still seeing that demand as Bill said. However, during the past year, under the revitalization scheme, buying old industrial building and redeveloping into a new style industrial building or office, I've actually seen that slowing down. Mainly due to two factors. Is one, the rise in interest rate and construction costs. That's one. And secondly, the office market. There are a lot of grade A office supply coming up. Right. So these projects, I actually see it slowing down in recent years. Yes.
Perhaps I also add a comment. From valuation and advisory perspective, because we have seen. I would say, conflicting, actions from within the government, because of the at the operational level, the interpretation of such terms like industrial use, warehouse use, and non-polluting industrial use, do have caused concerns among certain investors when they try to redevelop these sort of industrial lease sort of land. And I think these would need to be taken care of at a very, operational level to take care of. Perhaps, I can see that the time is running short. We can only deal with the last question here. Back to Fiona, and then I would appeal to our clients that if you have further questions, you can come to us separately. If you have certain question on to a particular sector, you can call our expert, directly. The last question that I would like to ask is, Fiona, because this is a question that have been so frequently discussed these days, and I don't think we have a concrete answer to that, but I would like to listen to it, Bill. There is a global trend of hybrid working, mode, work from home, working in the office. How do you see that impact or this trend onto the office footprint in Hong Kong? Do you see, operators or corporation looking for smaller footprint, than in the past?
Yeah, I think yes. I think in the past 2 years, actually, we can see most of the company they adopt hybrid work atmosphere. The reason is not about the reduction of footprint, is also another reason behind it. It would be to attract the young talents. And of course, I think on average, the number of the percentage of reduction, mostly, I think typical example would be 15 to 35% reduction. So of course, that will affect the total square footage to be leased from the landlord. So I think this trend will be keep going like this, because I think most of the companies still need a lot of the young talent to be working under the umbrella.
Yeah. So I would like to draw a conclusion to our session. As I mentioned, for clients who do have questions, for example, relating to industrial revitalization or sort of, redevelopment projects, please come to us and talk directly to us. Thank you all. Look forward to seeing you again, next time. Thank you.